Hi everyone, it's John. So today I wanted to talk a little bit about one of the most exciting items that I sell almost every day. And I specifically want to talk about planning for your retirement and having a plan. So when you're younger, let's say you're 40 years old and you're well established in your career and you're going to work for the next 30 years. Those are accumulation years. And those years are where you set aside, you pay off a mortgage, you put your children through college, you do different kinds of life moments, get them married, all those kind of things. But you're always looking toward that day when you're going to retire. That's having a plan. So let's talk a little bit about the plan. So most people have several little buckets. Probably the largest asset they own is their home, but then they also have a bucket for investments. They have a bucket for maybe a 401k that their company allows them to participate in. If they don't have that kind of vehicle, they participate in a Roth or an IRA. But everything, including the home, unfortunately, can lose value. We've seen even homes go down in value. Now that's rare, but it does happen. But certainly in investments, you see these ups and then you see the downs. And the tricky part here is that you don't want to lose money if you can avoid it. So let me talk to you today about what I call and what is being called by the author of a book called Juror Number One. And he explained it to us this way. It's an alternative retirement program. And what I mean by that is it has 4 components that are invaluable. The first component is that it gives you a death benefit. That will protect your heirs, your children, your spouse, anyone that you designate. The second part is it accumulates cash. An IUL, which is an Index Universal Life Policy, has this option, or not this option, but this feature that allows you to accumulate cash. You're investing in, let's say, the S&P 500. Now it has a cap of X amount, which is usually around 12%, and then it has a zero floor, which means your income can rise to 12% on your investments in any given year, but it can never go below zero. And so you protect that income. Remember a little bit ago, we talked about things going up and things going down. When it goes down, it takes years to recover. So imagine never having to participate in the downs and being able to participate in the ups. And that compounds over, let's say, 30 years. So you're 40 years old when you do this, and you're planning on stopping working at 70, and you want to enjoy your retirement. This gives you an additional resource. Now, number 3, as long as the policy is $150,000 or more, and we indicate the long-term care rider on your policy when we initiate it, if you are in need of it while you're still alive and you need to access the death benefit, you can do that because that long-term care rider allows for that. Let's say you have a terminal illness much later in your life, or you're hospitalized on a long-term basis and you need chronic care. So as a result, you can tap into that the death benefit of your life policy. And if you think about it, most people don't even think about long-term care until they're quite elderly, and they maybe actually have to put their parents into a facility and they realize the drain it takes. In my own case, I had to sell my father's home to be able to make that all work. And so what I would also want to point out is it has this 4th benefit, which I love. So as a 4th benefit, what you can do is, as this cash is accumulating and compounding, never going below zero in any given year, and up to 12% in the cap all the other times. And it's compounding and compounding and compounding. And you've probably heard that concept of compounding. It's time and money. And the longer the money gets to work and compound, the larger the total result. So I did an analysis here just for fun. And I put a 40-year-old male in average health. And he's putting in $400 a month, every month. And what happens with that is that person is getting a return after 30 years. And they're going to be able to take money out in their retirement years. And you can then ask the policy to stop paying premiums, because I'm stopping at work, let's say at 70, and start paying me. And it's a remarkable vehicle. And I'd love to sit down and talk with you about it. It is an excellent way for you to supplement your retirement income. Because there's only so much you can put into a 401k or a Roth or an IRA. And some people are excluded completely from a Roth or an IRA. And if you're a business owner, this is especially important for you. So I want to have a conversation with you. I want to go over your particular needs and talk to you about what this kind of a policy and product can do for you. Let's talk insurance. Bye-bye.